Aura Property Group, guiding you home.
Hi, my name is Jarette Petzer from Aura Property Group. Today I'm sitting with Nadia de Kock from Miltons Matsemela, and we are discussing all things capital gains. Nadia, what is capital gains tax?
Well, capital gains tax is a tax that was introduced in South Africa on the 1st of October 2001, more commonly referred to as the valuation date, and it applies to the disposal of capital assets on or after that date. The basic principle is that if a capital asset is sold at a profit, that profit is then subject to capital gains tax. Alternatively, if a capital asset is sold at a loss, the principle is that those capital losses can be set off against other capital gains. Now, a capital gain arises when an asset is sold for more than its base cost. A portion of that profit will then be included or added to a taxpayer's taxable income for the year and is then subject to normal income tax. So as a result of that, capital gains tax is not necessarily something that is separate or a separate tax, but rather something that forms part of an individual taxpayer's income tax for any specific financial year.
How is capital gain calculated?
Well, very simply, a capital gain is calculated by basically deducting the base cost of an asset from the proceeds on the disposal of that asset. Now, the base cost of a property generally comprises the actual expenditure incurred on that asset. Only certain expenditures, however, are allowed as allowable deductions to be included in the calculation of the base cost of the property. Now, these would generally be the acquisition costs of the property. Those would include things like expenses incurred on the actual acquisition of the property, things like your purchase price, transfer cost, bond registration fees, any professional fees that may have been incurred on the acquisition of the property, such as legal counsel fees or surveyor fees or fees for a valuer. Then, of course, also improvement costs can be included as an allowable deductible. Improvement costs would be expenditures incurred in respect of alterations or renovations to the property so as to increase the actual value of the property. Important, however, is that only improvement costs that you can prove via or with an invoice or a receipt will be allowed by SARS. Then other sorts of things that are included or may be included in your base cost calculation is the disposal costs of an asset. Those will be things like your estate agent's commission plus the VAT on that, advertising fees, and any valuation costs. I think the bottom line is, or the ideal is, to try and get your base cost as high as possible. In other words, get to include as much as possible within your base cost calculation so as to reduce the actual capital gain on the disposal of an asset to as low as possible, thereby in turn keeping your capital gains tax liability as low as possible.
Aura Property Group, guiding you home.